Audio Jungle. Audio Jungle.
No, the title of this video is not a clickbait. What if I tell you that this is a perfectly feasible plan unlike many other investing strategies found on the internet? What if I tell you that actual people in real life have been able to realize the gains of this strategy? What if I tell you that you don't need to be a trading whiz or an investment guru to make use of this time-tested technique? Hey guys, you're watching Omega Finance, where we share insights and technical analysis from the world of finance and investing. Okay, so making 1 crores out of a few thousands is really possible. Why isn't everybody doing this then? Good question. Maybe people have never heard of this phenomenon called compounding. Maybe they don't know how to differentiate between stocks that are worth gold and those that are worth nothing. Maybe they don't know that India's most successful investor, Rakesh Jhunjhunwala, not only owes his wealth to these two tactics, but advises other people to reap the benefits of it too. Or maybe they are not aware of the fact that history's all-time genius, Albert Einstein, called compounding the eighth wonder of the world. But the most important reason is this. People have not watched this video, so you're on the right track for now. Do remember to drop a like before we jump into the details. You have all probably heard the phrase that time is money. However, in the stock market, money is time. Why? Because the value of the cash you hold and the money you possess is dependent on and affected by time. How so? Let's say that 10 years ago you hid 10,000 rupees under your mattress. If you were to uncover that money now, not only would the cash be in a bad condition, it would be worth less because it can buy not as much as it was able to 10 years ago. Why? Because inflation is pretty much unavoidable in the long run. For example, in India, 10,000 rupees have lost their worth by as much as 600 rupees in the last 10 years. This means that in order to avoid your savings from depleting over time, you should try to get rid of this problem. Good news for you, since not only there is a way to maintain the value of your priced savings, but you can also possibly increase it over time. That's why everyone is so hyped about investing these days. Now that you've understood that every minute your cash spends just sitting around is a minute wasted, let's get to the further details of it by explaining how people actually make money from investing. You basically invest in a company's stocks or bonds. This gives you a little ownership of that company depending on the investment that you've made. This also means that you're actively betting on the company's growth, and if that happens, the value of your share increases, and hence you have now more money than when you first invested. So, how do we know where to invest? You might be wondering. We'll get to that later, but first understand a basic strategy you can apply all the time, no matter where you invest. 2 things we are going to do in this video. Understand compounding and get an idea about the useful stocks in the Indian share market. Let's start with compounding now. In a simple investment, you will earn returns and profits on the initial capital you have contributed. Let's demonstrate this by example. If you deposit a sum of 10,000 rupees with an average profit rate of 5%, 5% of the total amount, in other words 500, will be added to your account each year. 10,500 at the end of first year, 11,000 at the end of second year, 11,500 at the end of third, and so on. Yeah, sure. It is easy to calculate, but intelligent investing requires a little more brain. Compounding adds your profits to your capital investment and treats this as the new total sum. Thus, while the profit rate remains the same because your capital investment is increasing each year, actual profits increase each year exponentially. To refer back to the example at hand, the following will be your profit trajectory on an annual 5% profit rate. 10,500, 10,525, 11,051, 11,603, 12,183, and so on. Comparatively, at the end of the 5th year with simple profit, you would have 12,000. By applying compounding, you have an additional sum of rupees 183. While this might not seem as much right now, you get the idea. The good thing is, you can manipulate some variables to reap the most from compounding. To manipulate those, you need to get your head around them first. If you are underwhelmed about the power of compounding, this is an example which you can take. If a single grain of rice is the first day, and the number of grains of rice awarded each day is doubled over 30 days, at the end of the month, the number of grains you will have will be 536, 830, 912. Let's take the example of the Nifty index. Let's say you are still in your 20s. You are sick of the 9 to 5 cycle and plan to start your own business as soon as you retire. So, you decide to invest 10,000 rupees in the Nifty 50 index fund and contribute only an insignificant amount of 1,000 rupees monthly for a period of 40 years. So you can meet your expenses when the time comes. You keep patience and never withdraw any money from this account. You make use of your intelligence and set the compounding frequency to monthly. You hand this over to any of the Nifty 50 index fund so that you can average at a 12% profit rate. You're contributing such a minute sum that you don't even bother about it most of the time. But eventually, the day comes and you go to withdraw your returns. This is how much you've made. 1 crore 20 lakhs while actually contributing only 25 lakhs. That's the magic of compounding. And at a time when most people are worried about their future, you're all set to live your new life. To sum it up, money makes money. Here are the factors affecting your compound profit and how you can best use them to increase your returns. In short, there are a few tips that would help you reach the hallmark of 1 crores way early in life. Number 1. Early start. This is important, since gaining profits from compounding is a waiting game. For example, success is a function of time. It is really important that you start off early and give your investments the most space to grow over time. Warren Buffett is the only richest investor of all times because he started doing this at the age of 10. He is more than 90 years old right now. Measured by annual average returns, Jim Simmons is the greatest investor of all time, averaging at 66% returns annually. But he found his investing stride only after age 50. His wealth today does not compare to Warren Buffett's. Had he too availed 3/4 of a century to invest at this rate, he would be worth, please hold your breath, 63 quintillion, 900 quadrillion, 781 trillion, 780 billion, 748 million, $160,000. And yes, that's more than 60,000 quadrillion US dollars. I am not sure if a word exists in Hindi for such a high number. Anyways, start off early. Number 2, compounding frequency. This is really amazing. The more frequently you compound your profit into the capital amount, greater your returns. Why? Because this will provide your investment a greater chance to have grown in size every time profit percentage from it is counted. If you compound daily on an investment of 10,000 rupees with an annual profit rate of 5%, you will earn an extra 12. To put this into perspective. Number 3, initial investment. This should be obvious but needs to be mentioned nonetheless. The 5% of 100 rupees is less than that of 1 lakh, so just try to put your best. Number 4, profit rate. I'm sure you will have this question in your mind. Here's the thing, markets are neither stagnant nor extremely smooth. And that's the adrenaline in investing. On an average, people earn 10 to 15% returns from the stock market. This is far greater than the fixed 5% return of fixed deposits in savings account in banks. We'll get to the details of reducing the risk factor in a minute when we talk about potential investing options. Lastly, please have patience and clear financing goals in mind. You have to outweigh potential risks and outweigh the market. This requires the determination of a saint or a pandit, but again, so does life. The second portion of this video deals exclusively with the question of where to invest so that we can reap the most benefits. The usual path that people take is to invest actively in the stock market with the help of a financial broker. To do this, not only should you have a strong knowledge of how the market operates, but also remain in touch with the daily trends and changes. There are various types of stocks to invest in, and you might struggle to choose as a newbie. What we can tell you to do is actively look out for either of these two types, value stocks or growth stocks. Value stocks are of those companies that have a consistent track record of success and are here to stay. For example, Asian Paints and Colgate have such stocks. But here comes the problem. A company experiences the most intense relative growth when it takes the lead from an obscure company to one that is established. The people who had been invested in these growth stocks during this transformation are literally the most fortunate people in the stock market. But keep in mind that they did not randomly found their luck. They kept a close eye on these stocks and betted on their growth. This is easier said than done. I can of course tell you that companies such as NYKAA and Policy Bazaar own such stocks, but again, the research is for yourself to do because the greater the potential reward, greater the potential damage. So let's say you don't have the time or resources to do such demanding tasks but are still tempted to make money. Don't lose hope, viewers. This video from now on is just for you. Understand mutual funds. These are managed by professionals and don't require you to strain. Many people invest in them simultaneously, and the professionals invest in a variety of stocks, hundreds of them. The more diversified your investment, the less risk you undertake. Simple as that. There's a specific type of them we want to talk about today. Passively managed funds work under already set criteria, follow the trends of the market, and require few professionals. Then there's also the potential of SIPs, systematic investment plans, in which you don't rely on initial investments only but continually contribute from your regular income. These passively managed funds are also called index funds since they follow a set market index. There is an additional benefit of index funds which gives it weightage against actively managed ones. Since less professionals are employed, you will be charged a less service fee. This is especially important in a fund market where managers take outrageous fees for managing your company. To put this into perspective, service fees range from 0.5% to 1.5% in actively managed funds and 0.2% in passively managed ones. Notice the difference? Lastly, if the literal maestro of modern day investing Warren Buffett has actively advised to pursue index funds, maybe we should take notes. If I were to suggest a name for an index fund, whether it be the National Stock Exchange or the Bombay Stock Exchange, it would definitely be the Nifty 50. As implied by the name, this mutual fund keeps investing in the top 50 performing companies of the stock market. Two benefits of that. Firstly, this reduces the risk you take while making decisions. I mean, if all the 50 top countries of India crash suddenly, this must mean that a great crisis, economic or otherwise, is underway. So, even in the worst case scenario, which is highly unlikely, it will be only the global economy's fault and all of us will go down together. Second benefit is that of confidence. Not only are the companies in which the Nifty 50 fund invest the most popular at the time, the fund itself is the most popular choice for common folk like you and me. This reinforces trust in the market and companies and give them more potential to perform and grow. That is all from our side, where we talked about the wonders of compounding, patience, and strategy in the stock market. Please hit the like button. Feel free to share and subscribe because we have more such videos coming your way.